Here we have some riders that can be added to enhance the death benefit in a whole life policy. Remember the graph we drew earlier showing the face amount and the cash value growth over time? The first rider we'll discuss is the face amount plus cash value rider. With this rider, the death benefit paid out is the face amount of the policy plus the accumulated cash value. So, if Pearl's $450,000 policy has $20,000 in cash value at the time of her death, her beneficiary would receive $470,000. If the cash value grows to $100,000, the death benefit would be $550,000. This rider appeals to many people because it can help offset the effects of inflation. As the cash value grows, so does the total death benefit. However, it's important to note that this rider does come at a cost. The premiums will be higher than a policy without the rider. Instructor discusses the net amount at risk. In a standard whole life policy that does not contain the return of cash value rider, as the cash value grows, the amount of money the insurance company has to pay out of its own pocket, known as the net amount at risk, NAR, decreases. Early on, when there's little cash value, the insurer is on the hook for nearly the entire face amount, since the NAR is equal to the face amount minus the cash value. But as time goes on and the cash value grows, the NAR shrinks and more of the death benefit comes from the policy owner's own accumulated cash value. Let me see if you truly understand the net amount at risk. Pearl has purchased a $450,000 whole life policy with the cash value rider. What is the net amount at risk at the very beginning of the policy? The class responds in unison. $450,000. That is correct, since the formula is face amount minus cash value, and the cash value is 0 at the very beginning of the policy. Okay, then, what is the net amount at risk when Pearl is 100 years old? Class responds in unison. $450,000. Once again, that is correct, since the cash value will grow to equal the face amount at age 100 when the policy matures or endows. Throughout the life of the policy, ABC Insurance Company will always be on the hook for the total of $450,000 of their money, since Pearl bought the cash value rider. If Pearl had not added the cash value rider, then the net amount at risk at age 100 would be 0. Do you know why?
Let me take this one. Because when the policy endows at age 100, that means the cash value has grown to the point where it equals the face amount. And the net amount at risk equation is face amount minus cash value. So $450,000 minus $450,000 is 0.
I was nervous for a second there, Don, but you brought it home. That is the correct answer and the correct logic. Instructor contrasts the face amount only with the face amount plus cash value rider. With the face amount plus cash value rider, the insurer pays out the full face amount plus the cash value, which means they're not benefiting from the decreasing NAR in the same way. That's why the premiums for this type of policy are higher. The insurer is taking on more risk. Instructor introduces the face amount plus return of premium rider. Another rider option is the face amount plus return of premium rider. With this rider, the beneficiary receives the face amount of the policy plus all the premiums paid into the policy over time. Instructor uses Pearl as an example. Let's say Pearl is paying $200 per month, or $2,400 per year, for her whole life policy. If she dies after 10 years, her beneficiary would receive the $450,000 face amount plus $24,000 in return premiums, for a total of $474,000. If she dies after 20 years, the return premiums would be $48,000, for a total death benefit of $498,000. Instructor explains the appeal of the return of premium rider. Many people like this rider because it feels like they're getting all of their money back, even though the premiums were used to pay for the insurance coverage. The insurer is able to offer this rider because they invest the premiums and use the earnings to offset the cost of returning the premiums upon death. If the insurers were not able to make money, they would not offer this rider. Instructor compares the cash value and return of premium riders. Students often ask me which is better, the face amount plus cash value rider or the face amount plus return of premium rider. The answer depends on when the insured dies. If death occurs early on, when there's little cash value accumulated, the return of premium rider will likely provide a larger benefit. But if death occurs later, when the cash value has had time to grow and surpass the total premiums paid, the cash value rider will be the better option. Statistically, the cash value rider is more likely to pay out a larger benefit in the long run, assuming the insured lives a long life. Great job on completing this video. Now it's time to test your comprehension of the concepts we just discussed. This video corresponds to ICAP quiz course number 21. Remember that number. Click the link in the comments section to access the Insurance Class Assistance Program, also known as ICAP. Once you're there, look for quiz course number 21. This quiz will help us see if you truly understand the material and are prepared to move on to the next video. Don't forget, ICAP quiz course number 21. Good luck and keep up the great work.